Halfway to $1,000,000 is not halfway in time. Most people assume it is. If it takes you 20 years to reach $500,000, you probably think it'll take another 20 to reach $1,000,000. But that's not how compounding works. In reality, the first half often takes 70 to 80% of the time. The second half can happen shockingly fast. And that right there is the hidden mechanism almost nobody respects. The order of your financial moves matters more than the moves themselves. You can invest aggressively. You can save diligently. You can buy assets and still sabotage your wealth simply by doing things in the wrong sequence. Investing while carrying 20% credit card debt. Parking cash in savings while ignoring a 100% employer match. Delaying investing for 10 years because I'll start when I make more. A single decade of delay doesn't just cost contributions. It can quietly cost $300,000 or more in lost compounding. And here's the part that should bother you. Almost nobody calculates this in the right order. Today I'm going to show you the mathematically smartest order to build wealth. Not just what to do, but when to do it. We're going to break down why most people accidentally invert the sequence, how that mistake quietly slows compounding, and what the wealth building order should actually look like if you care about math instead of motivation. By the end of this video, you'll understand exactly where each dollar should go first. You'll see why timing beats intensity, and you'll understand why doing the right thing in the wrong order can cost you years. And this matters right now. Inflation has been eating into purchasing power. Wage growth, according to long-term Bureau of Labor Statistics data, tends to hover around 3 to 4% annually. Meanwhile, credit card interest rates are sitting at historic highs. If you don't get the sequence right, the math works against you. My name is John, and I spend way too much time thinking about wealth-building math and financial sequencing. If you're someone who's trying to save, invest, pay off debt, and build financial security but feel like you're spinning your wheels, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now let's get back to the real issue. Because the problem isn't usually effort. Most people are trying. The problem is misordered effort. They're investing before stabilizing. They're saving before eliminating expensive debt. They're chasing returns before building a base. And when you stack financial moves in the wrong order, compounding doesn't disappear. It just works against you. So let's break down the sequence that actually builds wealth the fastest. Here's what most people don't realize. Building wealth isn't just about doing the right things. It's about doing them in the right order. But most people don't build wealth mathematically. They build it emotionally. They invest early, without an emergency fund because they're afraid of missing the market. They rush to buy a house because everyone around them says renting is throwing money away. They aggressively pay off a 3% mortgage while ignoring a 20% credit card balance because being debt-free feels clean. Look, I understand the instinct. We're wired for action. Psychologists call it action bias. The urge to do something rather than sit still, even if that something isn't optimal. Then there's fear of missing out. The market goes up 15% in a year, and suddenly investing feels urgent. Social media shows someone buying their first home at 27, and now renting feels like failure. And social pressure? That's powerful. You don't feel pressure to optimize your tax efficiency. You feel pressure to keep up. But the math doesn't care about emotion. According to Federal Reserve survey data, roughly 60% of Americans would struggle to cover a $1,000 emergency expense without borrowing or selling something. That means a majority of people are investing, buying homes, upgrading lifestyles, without a financial foundation. And here's the issue. When you skip stability and jump straight to growth, you introduce fragility. And fragility interrupts compounding. Compounding only works if you stay in the game. If you have to pull money out during a downturn because your car breaks down, if you have to rack up credit card debt because you don't have cash reserves, if you panic sell because you're over-leveraged, you've disrupted the sequence. This is why order determines compounding power. Think of wealth like stacking weights on a barbell. If you load the outer plates before securing the center, the entire structure becomes unstable. I call this the financial stacking sequence. Each financial move sits on top of the previous one. Stability first, efficiency second, growth third, leverage last. When you invert that stack, you don't just slow progress, you weaken it. And this is where people quietly lose years, not because they didn't try, but because they stacked it wrong. And this is where people get this wrong. They want growth before stability. They want returns before resilience. Step 1 in the smartest wealth building order is simple. Build a real emergency fund and eliminate high interest debt. Not because it feels responsible, because the math demands it. Let's compare something basic. The long-term average return of the stock market is roughly 8 to 10% per year, depending on how you measure it and whether you adjust for inflation. Credit card interest rates right now, 20%, sometimes higher. So let's run the numbers. If you carry a $5,000 credit card balance at 20% interest, that costs you $1,000 per year in interest alone. That's not hypothetical. That's math. Now compare that to investing $5,000 in the market and earning, say, 8%. That would make you about $400 in a year, before taxes. So on one side, you're losing $1,000 guaranteed. On the other, you're hoping to gain $400 on average. That spread is enormous. Here's what that actually means. Paying off 20% debt is equivalent to earning a guaranteed 20% return on your money. No volatility, no risk, no down years. Show me an investment that guarantees 20%, and I'll tell you it doesn't exist. And yet people ignore this all the time. Why? Because investing feels productive. It feels like progress. Paying off debt feels like standing still. This is the risk tolerance illusion. People think they can handle market volatility, but they can't handle the certainty of debt quietly compounding against them. And here's where the emergency fund matters. Without 3 to 6 months of expenses in cash, one unexpected event forces you to reverse progress. A medical bill, a job loss, a car repair. You either liquidate investments at the wrong time or go back into high-interest debt. Both interrupt compounding. Now you might be thinking, but what about investing early? Isn't time in the market everything? Yes, time matters. But sequence matters more than speed. If your financial base is unstable, you won't stay invested long enough for time to work. Compounding rewards consistency, not chaos. Stability isn't boring, it's structural. And if you skip this step, everything you build afterward sits on a crack in the foundation. This is where it gets really interesting. Because after you stabilize, after the emergency fund is built and the high-interest debt is gone, the next smartest move isn't invest as much as possible. It's capture free money first. Let's say your employer offers a 100% match up to 4% of your salary. If you make $60,000 per year and contribute 4%, that's $2,400 from you. Your employer adds another $2,400. Instantly, that $2,400 you contributed becomes $4,800. That is not an 8% return. That is a 100% immediate return on your money. Now let's let that grow. If that $4,800 compounds at an average 8% annually for 30 years, it turns into roughly $48,000. And remember, only half of that came from you. You contributed $2,400 that year. But because you captured the match and allowed time to work, the total impact is magnified. According to Vanguard's annual How America Saves report, the vast majority of employer retirement plans offer some form of matching contribution, and the average match is typically around 4 to 6% of salary. And yet, a surprising number of employees don't contribute enough to get the full match. Look at that clearly. If your employer matches 4% and you contribute 2%, you are voluntarily rejecting part of your compensation package. Leaving the employer match behind is mathematically equivalent to taking a salary cut. No investment beats a guaranteed 100% return on day one. This is why sequence matters. You don't chase higher returns first. You secure the highest certainty return available. Free money isn't flashy, but over 20 or 30 years, it compounds into something very real. And most people overlook it because it doesn't feel aggressive. It feels basic. But basic, done in the right order, builds wealth quietly and powerfully. Here's the dangerous assumption. People think investing is just about picking good assets. It's not. It's about where those assets live. After you've captured the employer match, the next smartest move isn't just invest more. It's invest efficiently. There's a major difference between investing in a regular taxable brokerage account versus a tax-advantaged account like a Roth IRA or traditional 401k. Let's use simple math. If you invest $10,000 and it grows at 8% per year for 30 years, you end up with about $100,600. That's the power of compounding. But here's what most people don't factor in. Taxes along the way. In a taxable account, you may owe taxes on dividends every year. You may owe capital gains taxes when you rebalance or sell. That creates what's called tax drag. Even losing 1 to 2% per year to taxes might not sound dramatic. But if that 8% becomes effectively 6.5 to 7% after friction, your ending balance drops significantly over 30 years. That $100,600 might become closer to $76,000 to $85,000 depending on tax rates and structure. That's not a small difference. That's tens of thousands of dollars, just because of account placement. Compounding is like rolling a snowball downhill. The longer the hill, the bigger the snowball gets. But taxes are friction on the hill. They don't stop the snowball completely. They just slow it down. And small slowdowns, repeated over decades, become large gaps. In a Roth account, growth is tax-free. In a traditional account, you defer taxes and allow the full amount to compound before paying the IRS later. Both reduce friction compared to taxable investing. So here's the interpretation. Sequence isn't just about paying off debt before investing. It's also about reducing friction before accelerating growth. You optimize the environment first, then you scale. Aggressive investing inside a high-friction structure is like flooring the gas pedal while the parking brake is slightly engaged. You're moving, but not efficiently. And over 30 years, efficiency compounds just as powerfully as returns do. Now watch what happens when you wait 10 years. Let's say you start investing at 25 years old. You invest $500 per month. That's $6,000 per year. You earn an average of 8% annually. If you do that for 30 years, from age 25 to 55, you end up with roughly $680,000. You contributed $180,000 of your own money. The rest, about $500,000, came from growth. Now let's change one variable. You wait until 35 to start. Same $500 per month. Same 8% return. But now you invest for 20 years instead of 30. At 55, you'd have roughly $295,000. Not slightly less than half. And here's the part most people underestimate. You invested only $60,000 less in the second scenario, but you lost almost $400,000 in final value. That gap didn't come from contribution differences. It came from time. This is the part nobody internalizes. Delay costs more than increasing contributions later can realistically fix. You might say, I'll just double my contributions when I make more money. But doubling your contributions at 35 still doesn't recreate the compounding that happened between 25 and 35. Time is not linear in investing. It's exponential. The early years feel slow. The account balance barely moves. It doesn't feel exciting, but those early dollars become the largest dollars later. Time greater than intensity. This changes how you look at retirement. It's not about how hard you push later. It's about how early you stabilize, optimize, and start. Because once the snowball is rolling downhill, it's very difficult to recreate those first 10 years if you skip them. And this is why order and timing within that order quietly determine everything. This is the part nobody talks about. Once your foundation is stable, your employer match is captured, and your tax structure is optimized. Now you enter the true compounding phase. Broad market investing, not stock picking, not chasing trends, not jumping in and out, just consistent exposure to the productive engine of the economy. Historically, the S&P 500 has returned around 10% per year on average, nominally, over long periods. Adjust for inflation, and you're typically looking at roughly 7 to 8% real returns. Now that might not sound dramatic. 7 or 8% doesn't feel explosive. But here's the interpretation. If your money grows at 7 to 8% per year, and your wages grow at roughly 3% per year, which aligns closely with long-term Bureau of Labor Statistics wage data, your investments begin to outpace your labor. That's the divergence curve. In the beginning, your income is your primary wealth-building tool, but over time, something subtle happens. Your invested capital starts growing faster than your paycheck. Let's say you have $200,000 invested earning 8%. That's $16,000 per year in growth. If your salary is $80,000 growing at 3%, that's $2,400 per year in raises. See the gap? One line grows gradually, the other curves upward, and eventually, the investment line crosses the income line. This is when wealth becomes self-reinforcing. This is when compounding stops feeling theoretical and starts feeling tangible. And this only happens if you let it run long enough. Broad market investing works not because it's exciting, but because it captures economic growth at scale. You're not betting on a company. You're betting on productivity, innovation, and expansion across hundreds of companies over decades. And in the correct sequence, this phase becomes the engine. Your labor starts the process. Your capital eventually accelerates it. And when capital grows faster than labor, that's when financial independence stops being abstract and starts becoming math. And this is where people get this wrong. They try to use leverage before they've built stability. They buy a house with minimal reserves. They start a business without margin. They take on large fixed obligations before compounding has built momentum. A house before a foundation is fragile, and leverage amplifies mistakes. Leverage is powerful. It allows you to control large assets with relatively little capital. That's why real estate has created significant wealth for many people. But leverage is a multiplier. If your base is solid, it multiplies progress. If your base is weak, it multiplies stress. Mortgage rates over the past few years have fluctuated dramatically, moving from historic lows near 3% to levels above 7% in a relatively short time. That changes the math significantly. A 3% mortgage behaves very differently than a 7% mortgage. And yet, many people make decisions emotionally instead of analytically. Let me be clear, this is not anti-real estate. It's anti-sequencing error. Buying property after you have stable cash flow, reserves, diversified investments, and manageable debt is very different from stretching to get in the market because you feel behind. Through a risk management lens, leverage should be layered on top of strength, not used to compensate for weakness. The smartest order builds optionality first. Then, and only then, does it introduce amplification. Because once you introduce leverage, volatility matters more. And if you haven't built the base, the volatility can control you, instead of the other way around. Now let's make this practical. Here is the smartest wealth building order, clearly and calmly. First, build a 3 to 6 month emergency fund. Not because it earns high returns, because it protects everything else. This is your shock absorber. Job loss, medical expense, unexpected repair. None of these should force you into high interest debt or liquidation of investments. Stability keeps you in the game long enough for compounding to matter. Second, eliminate high interest debt, generally anything above 7 to 8%. If your credit card is charging 20%, that's not a maybe problem. That's a guaranteed negative return. Paying it off is mathematically superior to almost any investment option available. Remove the drag before you try to accelerate. Third, capture the full employer match. If your employer match is 4% and you're contributing 2%, you are declining part of your compensation. That match is an immediate 100% return on your contribution. Secure the free money. Fourth, maximize tax-advantaged accounts. Roth IRA, traditional 401k, HSA if eligible. Reduce friction. Let the full amount compound. The less tax drag you introduce, the faster the snowball grows. Efficiency before expansion. Fifth, invest consistently in diversified index funds. Broad exposure, low cost, long time horizon. This is where patience beats prediction. You don't need to outsmart the market. You need to stay in it. Automatic contributions, ignore noise. Let economic growth work for you. And finally, add leverage carefully. Real estate, business ownership, expansion, but only after the base is strong. Leverage should amplify stability, not compensate for its absence. This is the stacking sequence. Stability, eliminate drag, capture free returns, reduce friction, then scale. Most people do these steps, just in the wrong order. And when you rearrange them correctly, the math starts working with you instead of against you. Here's what most people don't realize. You don't need a new strategy. You need clarity and automation. So here's what you can do this week. First, calculate 3 numbers. Your net worth, everything you own minus everything you owe. Your interest rates, not just balances, rates. Highlight anything above 7 to 8%. That's financial drag. And your savings rate. How much of your gross income are you actually investing each month? Not what you plan to invest. What's automated? Second, automate what matters. If your employer offers a 401k match, set your contribution to at least capture the full match immediately. If you qualify for a Roth IRA, set up automatic monthly contributions. Even if it's not maxed yet, consistency beats sporadic effort. Remove willpower from the equation. Third, avoid lifestyle inflation. When income increases, don't immediately increase expenses. If you get a raise, direct at least half of it toward investing before you adjust your lifestyle. And finally, track 2 metrics over time: your savings rate percentage and your investment growth versus your wage growth. When investment growth begins closing the gap with your income, that's when the divergence curve starts forming. That's when wealth shifts from effort-driven to asset-driven. And that's the transition you're aiming for. Now zoom out for a second. Imagine yourself 10 years from now. not dramatically different, not on a private island, just stable. Your investments have been compounding quietly for a decade. Your emergency fund is untouched. High-interest debt is gone. Your accounts are automated. The market drops 20%. And instead of panic, there's calm, because your life doesn't depend entirely on your next paycheck, because your capital is working, because you followed sequence instead of emotion. Income becomes more optional. You work because you want to, not because every bill depends on it. That's the real goal. Not early retirement headlines, not flashy net worth screenshots. Optionality. Control over your time, control over your decisions, control over how much risk you choose to take. Wealth isn't about spending more. It's about needing less from the next month. And that only happens when compounding is uninterrupted long enough to matter. So here's what I want you to do. Comment your age and your current monthly investment amount. I'll help you estimate what that looks like in 10, 20, or 30 years if you follow the right sequence. Because once you see your future in numbers, this stops feeling abstract and starts feeling achievable. Before we wrap up, I want to be clear. I'm not a financial advisor. This video is for educational purposes only. Always do your own research and make financial decisions based on your individual situation. Everyone's income, risk tolerance, debt structure, and goals are different. What makes sense mathematically in one scenario may not apply exactly the same way in yours. Use this as a framework to think more clearly, not as personalized financial advice. Run your own numbers, understand your own risks, and make decisions that align with your long-term plan.